This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome, everybody, to the Definitely Uncertain podcast. My name is Darren Rockman. I'm a partner at Goldrock Capital, the 20-year-old multifamily office servicing families around the globe. And today I have my very good friend, David Jackson. Hi, David.
Hi, Darren. Thank you for having me on.
Thank you very much for joining. David is the founder and CEO of Seeking Alpha, which is one of the world's largest websites and apps for equity market research and for general investment discussion. David was the brains behind this company, and it's his baby. And I've asked him to come on the show to talk a little bit about some of the trends that are happening in the world of equity research and in trading. So, David, perhaps the thing that's caught everybody's attention over the last 6 months since the COVID crisis began has been the phenomenon of Robinhood traders. So can you tell us a little bit about what that is?
Robinhood is an online brokerage which eliminated commissions. It took commissions to zero. It's mobile first, and so its product is a mobile app, and it's optimized for mobile. It introduced the skill sets of UX optimization and gamification from Silicon Valley into the world of online brokerage, and as a result, has added enormous numbers of new investors into the brokerage world.
Right. Bringing new investors, particularly and predominantly young investors, millennials who maybe this is the first time they've ever invested.
Yes. And its focus on mobile has obvious demographic repercussions as well, meaning that when your focus is more on mobile, you're going to bring in younger people, where the typical demographic for many investment services is, males generally, from age 40 to 70. With a mobile first focus, you're going to bring in a lot of younger people, and that's what Robinhood has done.
Right, and it makes investing feel like choosing a film on Netflix or, a room on Airbnb or a date on Tinder.
Sounds right.
Okay, so how is this phenomena, commission-free trading and a gamified app, how is that changing the behavior of individual investors? What is it doing to the investor itself?
This has simply brought a lot of people into investing who previously weren't in investing. And I think it's important to recognize as well that this isn't limited to Robinhood. When the effect of Robinhood eliminating trading commissions then created a price war among the online brokerages, where the other online brokerages eliminated their trading commissions. And if you look at the number of new accounts being opened, it's also rocketed recently for other online brokerages. So, for example, in the second quarter of this year, E-Trade added about 325,000 new accounts, which was 10x the number it added in Q2 the same quarter a year ago. Checks are being sent to lots and lots of people, and lots of people are spending lots of time at home, and many people can't go to work. And so you see that there are YouTube videos or articles about people who have decided to spend their time trading because they can't work.
Okay, so the first impact is just a whole lot of new investors coming into the market who have now access to the market. What other behavioral things are we seeing as a result of this phenomenon?
Robinhood investors trade a lot more than investors with brokerage accounts with other brokerages. And in particular, they trade a heck of a lot more options than people with other brokerage accounts. According to one estimate which is out there, Robinhood investors traded options 88 times as much as Schwab investors in the first half of this year. And I think that to truly understand that, you have to look at business models. You have to understand how is Robinhood making money, and therefore what's it incentivized to do. And Robinhood makes money by selling trading flow, order flow, to people who will buy that order flow and use it to gain a trading advantage. And it makes particularly large amounts of money from options trades.
So it's effectively encouraging, by its business model, it's built to encourage young, inexperienced investors to buy options, which tend to be the most volatile and dangerous part of the equity market.
Well, I'd be a little careful here, right? Because I think it's easy to be very condescending about Robinhood investors.
Who, me condescending? No, never.
I'm not saying that you were. There's a lot of discussion out there with a lot of people saying, these people don't know what they're doing, and they're doing bad things. And I think it's important to kind of separate out two elements of this. One is Robinhood is doing real good by bringing people earlier on into the world of investing and owning equities, and doing it in a way which is accessible and user-friendly. Robinhood investors gravitate towards technology stocks. And if you look at what's happened in the market, the most successful stocks have often been growth stocks with a strong technology story behind them. And if you contrast that, let's say, with professional investors who do what on the surface is very sophisticated stuff, like sum of the parts analysis with a catalyst, and many professional investors, hedge fund managers, are value oriented, and value has chronically underperformed the market over the last 5 years. So the key thing which I want to say is we need to be very careful in this discussion in not being dismissive of the Robinhood investor, right? On the other hand, I think that your question picks up on something very real, which is if Robinhood's business model incentivizes it to get people to trade very frequently and to trade options, is that good for its users? And there the evidence is completely unambiguous, which is it's bad for investors. Individual investors do well by buying stocks and holding them for the long run. Investors lose money when they try to time the market or if they overtrade. And in the options market in particular, your trades are very short term. Time is working against you because it's embedded in the option. And there's a sophistication to options trading and options models, which gives the advantage to professional investors who really understand options trades. And so you don't want to be on the other side of the trade of those people.
So I want to pick up on a comment you made before with regard to technology and the fact that these traders have gravitated towards technology stocks, and the fact that technology stocks have outperformed. Cause and effect. Is the outperformance of technology stocks due to the fact that there's been so much money that young investors who are very technologically savvy themselves, they're buyers of iPhones, they're users of Facebook and Facebook properties, they're watchers of Netflix, have gravitated to these brand names, and that's dragged the algorithmic trading, and then the short-term algorithmic trading, and the long-term algorithmic trading? How much of this is actually being caused by the Robinhood investors rather than the other way around?
I don't have hard evidence, or I don't have the data to really be able to answer that question. But I strongly suspect that the answer is no. And the reason is, firstly, we do know what the average account size is of these younger investors, and it's really small. And so the money flows as a result of all of these trades is not large compared to the money flows of generally much wealthier investors with Fidelity accounts and Charles Schwab accounts. And I think that the second part of this is that what's really driven the outperformance of technology stocks is not money flows. It's the fact that coronavirus has accelerated trends which were in favor of technology stocks beforehand, and that, if you like, the future is happening much faster, and technology owns the future. And as a result of that, technology stocks have massively outperformed. Where you do see it is with very small stocks, right? You do have a phenomenon where Robinhood investors often, pile into small stocks with momentum, and then the money flows can make a big difference. And there are famous examples of
the Zoom example.
Yeah, and TLSA, right, where there was a lot of discussion about whether TLSA spiked because people were mistyping TSLA, right?
Thinking now buying Tesla and buying something else.
Exactly.
Yeah. Okay. What are the implications of this phenomena for professional investors and high net worth families who generally will not behave in the same manner?
I'm not sure that the introduction of this new group of investors, these big cohorts of investors, fundamentally changes the market. Because if it's not profoundly affecting asset prices or distorting asset prices, and I don't think that there's evidence that it is, then I'm not sure that there are strong investment implications. I think there's a deeper lesson here about investing tools, that we're seeing a process of democratization of trading and trading tools, and the characteristics that make services like Robinhood really successful, like a really attractive UX, the fact that it's mobile friendly, all of these things are going to impact the professional world of investing more and more. It's not that there's a world out there of dumb Robinhood people, and then the professional investors with wonderful tools, who are the smart people. I think the improvements which are being made for individual investors also impact professional investors as well, and up the game for professional investors. I think that what will happen is that a lot of the short-term trading and options trading will end up being unprofitable for those, and it will reinforce people in their view that individual investors and even professional investors tend to do better holding stocks for longer periods of time and not trying to be too clever with things like options.
Now let's talk a little bit about investment research. Of course, that's really what Seeking Alpha is all about, so you're really well placed. What changes are you seeing in the investment research world?
The first change is that sell-side research, in equity research from investment banks, is in crisis as a business model. You've got the unbundling of trading from research fees, and that's leading to a continual shakeout in the industry and a reduction in equity research coverage by investment banks. All of that coverage is migrating to Seeking Alpha. So Seeking Alpha covers vastly more stocks than the sell side covers. And every time, sell side coverage dries up on a stock, the discussion just happens on Seeking Alpha. I think so the first change in the equity research market, which I think is really, really significant, is tremendous downward pressure on fees, leading to a shakeout in the market and a move to non-traditional equity research like Seeking Alpha.
Okay.
I think the second change is that UX really matters. That tools which were developed and processes, this is exactly what we're discussing with Robinhood, for retail investors are actually just good for everyone. You want a really user-friendly interface. And many professional investing tools are just outdated in their UX and what the actual experience is. And then I think that the third change which is happening is, and this has been a trend which has been going on for a long time, is the democratization of research tools, where data and tools that previously were only available for professional investors are now available for retail investors. I'll give one example of this. Seeking Alpha acquired a company called CrestCap, which was a quant company that grades stocks with a quant rating and also provides factor grades for each stock. So it gives a grade for each stock of its value, growth, profitability, momentum, and its EPS revisions. And that product was developed for institutional investors and sold at $5,000 a seat. We acquired the company and include those ratings in our premium products for individual investors that cost $240 a year.
Right.
And we're seeing this phenomenon, I think, quite broadly, that data and tools that were only provided to institutional investors are now available to a much, much wider group of investors.
When you're talking about democratization, so on one hand, equity research is now more widely available for a lot lower price. But on the other hand, you can have all types of people writing about a stock. How is an investor supposed to qualify and understand how well the person they're reading really knows the stock?
That's a good question. That's one of the things that we focus on. So, for example, we report track records of our contributors under their articles. Again, for our premium subscribers, we show the history of their rating on the stock so that you can see kind of, where they were. I think you can look at writers about stocks, and you can look at, do they cover other stocks in this sector? And what's their level of expertise? I also think that you could just tell a lot by reading an article, how well this person understands the stock. The other element of this is comments are incredibly important. I was a sell-side analyst. I used to publish research, and there was no feedback loop. You had no idea how your clients were reacting to it. What we see on Seeking Alpha is, for example, that most of the stocks, the management teams of the company being written about, are all getting email alerts from us that this article has been published. So large numbers of people within the companies being written about are reading the articles. The people
it's almost like a triangle. You've got research guy in his basement. You've got investor in his basement, and actually you've got CEO in his basement because he can't go to the office. And all of these people are now sort of interconnected digitally and virtually.
Yes, exactly. And so the comment discussions on Seeking Alpha, often they'll include some vacuous comments, but in many cases, there are gems in the comments by people who deeply understand what's going on, who previously couldn't publish their opinion. What I think kind of non-traditional research like Seeking Alpha doesn't have is models and estimates. And building models for companies and publishing earnings estimates are really crucial for the functioning of the market.
Yeah.
And so you have to know, what the forward PE ratios are on stocks, and to do that, you must forecast future earnings estimates. And so I think that we're still very reliant on the sell side for earnings estimates. But in terms of qualitative analysis of companies, I think that non-traditional research like Seeking Alpha is taking enormous market share. And by the way, is being ubiquitously used by professional investors.
Right.
This is not only an individual investor phenomenon. They're all using the site as well.
Okay. So I always like to end up podcasts with a couple of hints for families, and particularly the families that listen to this. And here I think I'd like to ask you about millennial children. Okay, so many of our families have millennial children who have very little exposure to finance and investment. What would you suggest they do in order to help better prepare their children for investing in the future using some of the tools you described?
I think just encourage them to invest. Maybe give them some money and say, this is for you to invest. Where do you want to, research this? Where do you want to open your brokerage account? And what do you want to use? We had a remarkable piece of feedback on Seeking Alpha from somebody who contacted us and said, I decided that I wanted my children to be educated, and so I bought premium accounts for 4 of my children, or I gave them the money and told them that it was for a Seeking Alpha premium subscription. I know that 3 of them used the money to buy a subscription. I'm not sure what the 4th one, but I left in the room to decide. I think that investing is a really good thing. It's fun. It helps people think about the future. It's fundamentally optimistic, and so it's good psychologically, and it teaches people analysis, which in a way which provides good business skills for people. At some point, even the people who currently are trading momentum, at some point they get to start looking at balance sheets and understanding what earnings estimates are and EPS and understanding what makes a company more profitable. All of that's great. So what I would say is, don't be too kind of narrow in your requirements. Just encourage kids to invest.
And if you get 3 out of 4 of them spending the money on an investment tool, you're probably doing very, very well.
Yes, that's a great outcome percentage wise.
Exactly. Well, David, thank you very, very much for joining Definitely Uncertain. It's been great having you. It's been a fascinating discussion, and best of luck with Seeking Alpha. And thanks.
And Darren, thank you to you. This has been terrific. I'm a fan of your podcasts, and I'm honored to be invited and to be on it. So thank you.
You're very kind. All right, then. Thanks, everybody. If you enjoyed the show, you can subscribe. Apple Podcasts. We post it on LinkedIn, also on YouTube. Thanks, everybody. We'll see you next time.